without further ado, please join me in welcoming 1015 Associates, co-founder, chief investment officer, and my mother, Debbie DeMatteo.
Thank you very much. You guys can have a seat.
You don't need
I get left up here alone. I'm going to start. First, I want to say thank you all very much for coming and enjoying such a special night with us tonight. Milestones, to me, are a point of reflection, a time in which we look back of where we've come from, where we are, and where we're going to. I look back 30 years ago, and I'm certainly very pleased with the career path that I chose that brought me here tonight. I want to give a special thanks to many of you here tonight who are long-term, loyal clients, and that we can mark our time together now in decades, not in years. I want to thank our new clients and welcome them into what we like to refer to as the 1015 family. You are what we represent. You are lifeblood, what we are and what we become. So we want to thank you and welcome our new clients, and we'd also like to welcome our guests tonight. We hope you have a wonderful evening. I also want to thank my staff. They make my job look easy every day. And a special thanks to Mike tonight. What most people don't know is that it was Mike who talked me into starting this business 30 years ago. It was me, and most people don't know this either, who asked Mike to marry me. What a partnership. You know, we say we love what we do, and we say we're still passionate about what we do, but I'm a believer that actions speak much louder than words. And I'm going to share a quick story with you tonight as well. I'm going to fast forward now to the present time. And I'm going to call this story the timeline of the Brexit in the DeMatteo household. Thursday, June 23rd, day of the vote. Mike and I have a normal day. I happen to be in our Fishkill office for meetings. Mike, I believe, was in Goshen for the day. And so we went about our days. I finished up meetings and went on home for the evening. It's Thursday night, so Mike is at golf. So I knew he'd be home a little bit late, so I went about my chores, the things that I had to do in the house that evening. Oh, and did I mention that we were going away for a long weekend? So he gets home, we throw a few things in the car. We had a really early flight out of Westchester County Airport on Friday morning. So we decided, I like to be organized, so we decided that we'd get a hotel right down near the airport so that we wouldn't have to get over the bridge in the morning. So we went down, it was late, we hadn't eaten, we grabbed a bite to eat, went upstairs, it's about 11 p.m. now, check our phones, headlines are coming in. Only about 17% of the votes are in, but it's not going the way everybody thought it would go. So we go to sleep, 4 a.m., we wake up, flip on the television, Dow futures down 700. 4:05, call the airport, cancel the flights. 4:15, in the car on the way home. 5:15, in the gym, working out like any other Friday morning. 7:30, we're in the office, ready for a normal day's work. 8:15, 8:30, the staff shows up. Nobody's even surprised to see us. That's what we do. And I think our title this evening speaks to that. Be calm and look for opportunity. We were buyers of the market on Friday and Monday. We weren't sellers. We weren't there to panic. We were there to look for opportunity for you guys. So that is what we do. We love what we do, and 30 years later, We want to thank you for the privilege of working for you every day. I'm going to start with a quote, which I think is very pertinent to today's markets. It's from The Intelligent Investor by Benjamin Graham. The market is a pendulum that continually swings between unsustainable optimism when stocks are too expensive and unjustified pessimism which makes them too cheap. The intelligent investor is a realist who sells to optimists and buys from pessimists. In other words, buy low and sell high. In this market, that has become exceptionally challenging. It is difficult from day to day to discern whether we're in optimism or pessimism. It is a really difficult thing. And what I'm going to tell you tonight is that we're certain of one thing. There's a lot of uncertainty. So we're going to talk about a lot, but for those of you who are familiar with our program, we're going to get you started by thinking with a few trivia questions. And for anybody who's new, this is kind of tradition, so we're going to go through a couple of quick trivia questions to get your minds thinking. What flag will a team of refugees compete under at the Olympic Games in Rio de Janeiro? The flag of the Vatican, the Olympic flag, the flag of the United States, or the flag of Europe? The Olympic flag. A team of 6 men and 4 women will march behind the Olympic flag this August. So what's going on? For the first time since record keeping began in 1749, Sweden has more Nielsen's than Carlson's, Roxette fans than ABBA fans, or men than women. Men than women. And this is a country that has catered to the equality of women. So if there's any single ladies out there looking for new residents, maybe Sweden should come on your list. There's a new celebrity moneymaker, emojis. Which of these famous names has not released an app featuring himself or herself? Justin Bieber, Tyra Banks, Stephen Curry, or Kim Kardashian? We could all eliminate Kim, right? Tyra Banks. And guess who else has emojis out there? Your past and present presidential candidates. We will obviously be talking about that tonight. So, where did we start off the year? We came into 2016. We were together just 6 months ago. And my, isn't the world a different place? We closed out 2015 with absolutely no clear direction of which way this market wanted to go. You could have made an argument easily for the positives as well as the negatives. We had no direction of which way things wanted to go. Well, as you all know, the bears very quickly took charge. And by mid-February, we were in full correction mode, fears of a financial crisis, fears of a recession, fears that the correction was going to lead into a bear market. And on February 11th, the market turned on a dime, and as quickly as it had gone, it raced right back up again. We bounced around for most of May, and then, as you know, we hit June, that sharp line down on the bottom, where we had our 1,000-point decline in 2 days from Brexit. And then we know where we are today, and what a wonderful day to celebrate our 30th anniversary with new all-time highs in both of the markets today. So how have investors been feeling? There's a study, the American Investors Institute, that polls investors every week and asks them how they're feeling about the markets. And it tends to be what we refer to as a contrarian indicator. And that has held true this year. Literally on February 11th, the bearish sentiment in this market peaked at 49%. Meaning in February, at the lows, 49% of investors felt the market was going to go lower. That's exactly when the market turned around. And by the end of June, when we closed out the first half, it was equally divided bulls to bears. That indicates a very high degree of uncertainty and a high likelihood that the market will break one way or the other. And I've said to a lot of the clients that I've been meeting with, especially over the last couple of weeks, we're doing a lot of preparing for the negatives. You've always got to be prepared for your downside. But I said, you know, we don't want to be out of these markets too much, because when everybody's worried about all the things that can go wrong, the likelihood is the surprise is to the upside. And so far, that's what we're seeing. So what's the problem out there? Well, I don't think we've met for the last 4 or 5 years that we haven't talked about the Federal Reserve, so we might as well get right to it. Federal Reserve in the beginning of the year said that they were going to raise interest rates 4 times this year. Well, we got hit in June with the May jobs report, in which this country created 38,000 jobs. The expected number was 162. Well, the Federal Reserve very quickly did an about face. The probability of a June rate hike went from 20% to less than 5% overnight. If you don't think this confuses the market, when you start to prepare your portfolio for a multiple of hikes and all of a sudden it just goes away, this creates a lot of uncertainty. And we have a Federal Reserve that finds it necessary to verbalize the thoughts and the condition of what's going on within the Federal Reserve. And so week to week, she's jockeying these markets around. She comes out one day and she said, proceeding cautiously will allow us to assess the growth. Just 1 week earlier, she had said, proceeding cautiously will allow us to verify the growth. These small parsing of words send stocks heading in one direction or the other. So the Federal Reserve is going to continue to be a source of confusion. That's not a typo, by the way. Will they raise rates by 2018? Even St. Louis Fed president in June threw in the towel and said, we're probably not going to raise rates now until 2018. Well, I ask you this. If in January, when we were together, and they were talking about raising 4 times, 6 months later they tell us they're not going to raise for a year and a half, what can we possibly expect over the next 6 months? What are they going to do with the jobs report we just got this month, which was much better than expected? Are they going to change their minds once again? It causes a lot of uncertainty in the markets. What does that mean to interest rates? We came into this year, and for one sure thing, interest rates were going to finally go up. 10-year Treasury rates to start the year were a little over 2%. By all estimates, interest rates by the end of the first half would be about 2.7 or 2.8. Last week, we made new historic lows in 10-year Treasury rates. We traded at 1.3%. So everybody had their portfolios positioned for rising rates. Meanwhile, rates have collapsed. I want you to take note of that orange line running across the top of the screen. That line is the average annual 10-year interest rate from 1966 through 2015. It gives you a very good visual reference of how far below average we are right now. The one good thing about declining interest rates is it can be a catalyst. You know, they're already talking about the new wave of refinances. That's great for the housing market. It's good for the consumer. It's good for the economy. They've got more money to spend. It's not going to help the housing market at this point. I mean, people aren't going to rush out and buy a house just because rates are lower. But there are some positives, and we refer to it now lower for longer, that we're going to have these lower interest rates for longer than we thought. How about growth? Every time we meet, we talk about the economy finally kickstarting and growth taking off. We're 6 years into this recovery, and we're hoping for 2% growth this year. That's a disappointment by any measure. If you look at the years from 1980s and 1990s, we got very accustomed to 4 and 5% growth. So when you're growing at 2, it feels like a recession. Some of the problems that we have, I don't think they go away anytime soon. We can blame Congress for their inability to legislate and come up with any fiscal policy for the last 4 years. We can blame this administration. We can blame a lot of things. But you know, I think we have some structural issues out there that we really need to think about. I'll call it slower for longer. We've got an aging population. That means the likelihood of faster growth is not really that much in front of us. And I'm going to tell you one more thing that I don't think gets enough attention: the impact of technology in our economy. Back in the 1980s and 90s, technology was the boom. That was where the jobs were. That was where the growth was. I think technology is a marginal negative to the economy. When you think about things like driverless cars, have you thought about what will happen to the trucking industry? How about taxi drivers? What are all those people going to do? Simple things like the availability of the internet. The hotel industry spends hundreds of millions of dollars building beautiful hotels and resorts so that when you and I travel, we've got a great place to stay. Just go on Airbnb and you can stay in somebody's bedroom for half the price. What does that do? Industries are changing and will disappear in front of our eyes. That certainly can't be good for growth. So I think there's structural changes that are underway that we can't really reverse. And so I say interest rates lower for longer, growth slower for longer. That's the world that we're going to have to work in. When I talk about GDP, you know, it's a term we throw around, and I'm long ways out of economics school myself. So I think it's important and to try to assess what's going on out there if we understand what GDP really is. Where does growth come from in the economy? The first bar on the top, that represents net exports. Notice that that's a negative. The top set of bars, by the way, is 2015. The second group of bars is the first half of 2016. So if you see exports, a drag on GDP last year, largely due to the rising dollar. Our strong dollar means that our goods and services are more expensive to foreigners, cutting into our exports, taking away our growth. The next line on there is business spending. And this is interesting. Last year, business spending was quite robust. That's when businesses do things like build a factory, buy machineries, buy tools, buy real estate. That was a big positive in 2015. 2016, it's negative. If you're running a Fortune 500 company and you come into 2016 with all the uncertainties, and we've only been talking for 5 minutes, you've got an election in front of you. You've got an economy that's slowing down. You've got a market that doesn't know which way it's going to go. Are you going to dig into your pockets and build a new plant and hire new people when you see all that uncertainty in front of you? Business spending is declining this year. It's taking away from GDP. That big red line, that's you and I. We're 2/3 of GDP. What we do every day matters. The consumer has been relatively strong. We have more money in our pockets because of the surplus from energy, but we haven't seen it really spend through to the economy in any big way. So the consumer's doing okay, but not great. And then that little purple bar, that's government spending. Government spending for the first time in a long time is actually increasing. We got to think about government spending as a double-edged sword, right? The very back end, that right-hand side of your charts, that indicates a decline in government spending. The Budget Control Act of 2011, known as sequester, put major budget caps on big government spending for the last 4 years. And the government has been a detraction from spending. Well, it's getting better, but you know, that has two sides. The top red line is an indication of spending. You see that big peak, that big shoot up? That's the financial crisis. Government had to step in, spend a lot of money right there in the middle of the chart. GDP collapsed. You had this huge gap between spending and revenues. As spending has come down, revenues have recovered. We're getting to a better place. But the long-term trajectory still says that our revenues will not meet our expenses. And that's how we get here. The top blue line, the very far end there, you can see that the deficit is declining. We're heading in the right direction. You know, and the administration will go on and tell us all about how much they're doing such a great job reducing the deficit. But it's still a deficit. That big red mountain, that's our debt. We continue to go into more debt every single year. We are $19.3 trillion in debt right now. That represents $60,000 for every man, woman, and child in the United States, and $160,000 to all you taxpayers. Now, that's a big burden on our backs. The Bureau of Economic Research did a study and said economies whose GDP to debt gets to about 90%, guess where we are, it'll take away 1% growth. So, as I said, slower for longer. We're going to be paying this off for many, many years to come. So, how do we go about doing that? There's actually an online game that you can kind of make these compromises and decide, you know, well, I'll give up this and I'll go to that. And, you know, the fact of the matter is, we're going to have to cut programs that we want to, and we're going to have to cut a lot of programs that we don't want to. And when you look at where our budget really goes to, do you know we have a $4 trillion budget? You know what the number one item is? Medicare. $1 trillion. Followed right up behind that is Social Security, $900 billion. With the aging population, do you think that there's a politician out there today that's going to cut Medicare or Social Security? Not anytime soon. Right up there in the top numbers, defense. We spend $600 billion a year on defense. With the terrorism that we're seeing around the world and right here on our soil today, are we going to really cut the defense budget right now? And guess what? That $19 trillion in debt costs us $250 billion a year in interest service. When interest rates go up, do you think that number is going to go down? So, when we're dealing with these things, it's going to be a long road to recovery as far as how do we begin to fix some of the structural problems. Well, enough about our problems. Let's take a look around the rest of the world and see what's going on. This chart here, the purple line, represents the GDP of each one of these represented countries. On the left, we have our developed economies, and over on the right, we have our emerging economies. The orange line is the performance of the represented stock markets. So you take a place like Brazil, although they're not growing, their stock market is doing great because investors believe in the future growth. There's less debt, they're younger, they're commodity-based, so they feel there's better opportunity for growth there. Now look at China. China's growing. Stock market's down almost 20% this year. What about China? China says that they're growing remarkably 6.7%. Their target's between 6.5 and 7, so why not mark it right in the middle? We're growing at 6.7. Does anybody believe it? No. Kind of makes you uncertain, right? Well, the Chinese government really has their hands full. They are trying to move to a more market-based and consumer-based economy. So they decided that they'd start to let things float a little bit more with the market. So 2 times in the first quarter, the Chinese stock market shut down. So we have stopgaps built into the US market that if the market declines by a certain amount, we'll halt trading, kind of let everybody catch their breath, and restart trading again. In China, they decided, we'll stop it, we'll go home for the day. Everybody will feel better, they'll be a little less panicked when they come back to work tomorrow. Well, they tried that, they came back to work, within minutes, down another 7%, shut for the day. If you don't think that causes outright panic, people are afraid they wouldn't be able to get their money. So guess what? The government had to step in. So as much as they're trying to allow their currency and their markets to float, they don't want to take the negative side with it, so we have no idea of how things are really working in China, which is going to continue to add a lot of uncertainty to the markets. What about Europe? Well, the dark blue line in each of those bar charts represents the percentage that net exports contributes to GDP in Europe. Europe is highly, highly dependent on their exports. Now, this has a huge significance. The economy doing well in Europe matters. If the United States or China slows down, it's going to make things in Europe worse. They depend on the stability of our economies to run theirs. And now enter Brexit. All of those trade agreements have been negotiated as a united entity. What happens when they start unraveling all those trade agreements and Great Britain is sitting on the other side of the table? It's going to cause a lot of dislocations in all of the trading and all of the agreements and all of the economies in Europe. Unfortunately, we don't know the timing, or we don't know exactly what's going to happen. But Europe has major dependence on their exports. Let's talk about what they're doing in their bond market. The ECB is writing a new page for quantitative easing. Back in 2011, 2012, our Federal Reserve was buying US bonds in order to support the economy. It was a form of quantitative easing. The Europeans have taken this one step further. They've decided, well, we'll buy the bonds of the utility companies, and we'll buy the bonds of the telecom companies, and we'll buy the bonds of the insurance companies. So guess what? These companies are issuing debt by the truckload. And doesn't Europe have a debt problem? And all they're doing is issuing more debt. You know, and it kind of reminds me of that movie, A Field of Dreams. If you build it, they will come. Over in Europe, if you issue it, they will buy. And what's happening is it continues to press yields lower and lower and lower, which is causing confusion around the world as far as where will interest rates eventually go. So here we are. Interest rates around the world are declining. Europe is swimming in debt and trying quantitative easing. We don't trust the numbers that are coming out of China. The Federal Reserve is on hold, but we don't know for how long. And now here we are, we're down to 2. We've got Hillary and Trump. They are the 2 least popular presidential candidates in history. And you know, when I meet with some of you, the discussion comes up. They're like, is this really the best that we can come up with? And you know, I kind of step back from that question and think about it and say, you know, if you had to figure out how to fix $19 trillion in debt, a crisis that's going on around the world, do you want that job? I guess the smart people decided to pass. So we've got an election that's going to go on, and that is certainly going to lend some uncertainty into the markets. So with all this bit of backdrop that's been going on out there, how are the markets doing? We know how they're doing today. And we certainly got a really big surprise rally that's underway. But at the finish of the first half, and the red bar is the first half of 2015, the blue or purple bar, whatever that is the first half of 2016. So S&P 500 finished the first half up about 2.5%, better than where we were last year. As you know, we've tacked on to those returns. The second sector there is the global markets, the big developed markets, China, Japan, not doing so well. That's one of the areas that's underperforming this year compared to last. Gold is one of the top performing sectors of the year. That in itself should raise eyebrows. When gold is one of the best performing assets, we have a sense that investors are nervous about something. On the right hand there, the REIT sector. The REIT sector did terrible last year. Why? The Fed was going to raise interest rates all throughout 2016, so everybody was dumping their big interest-bearing stocks. Well, guess what? They're not raising interest rates. REITs have been one of the top performing sectors this year. And then there's commodities. Now, we were together, many of us, in January. Would anybody have guessed at that point that oil would be up 20% this year? I don't think so. It's been a wild ride. Speaking of oil, oil hit a low of $26 a barrel in mid-February. It climbed its way all the way back into the 50s, basically almost a double. We're trading today somewhere in the mid-40s. When we met in January, we talked about if, and it was a big if at the time, if oil could get back in the $40 to $60 range, that would be the sweet spot. That it would be low enough that it still counted to the consumer. It was a big enough cut at the pumps that it would be a stimulus to the economy. And it would be high enough that we'd keep the energy industry alive in the United States. And that's where we sit today, right around $45 a barrel. The EIA projects that oil should trade in a range right around 50 between now and 2017. That would be an ideal scenario for oil. These are the places that have oil reserves. The first line in each set, the first bar, are the amount of reserves that each of those respective areas has. The bar charts following that is the increase in revenues if oil were to move from 40 to 60 and to 80. The reason that's significant is gradually rising oil prices. We don't want an oil shock, but gradually rising oil prices over the next several years could be a tailwind to the global economies and actually be very good for the markets because of the revenue that will be generated in all of these areas. The US dollar is lower. And I know talking currencies is kind of confusing, but I want you to look at the very far right, that back 10% of the chart. That green line on the top represents the US dollar. That big shoot up is the rising dollar in 2014 and 2015. Now, they tell us that oil and the dollar have an inverse relationship. That black line on the bottom, that's the price of oil. It doesn't get any more textbook than that. Dollar was going up, oil was collapsing, and I'm not sure whether it was a chicken or egg, which one happened first, but they both turned around. Dollar's been declining in 2016. That's good for our exports. That's going to help us as the dollar declines. Oil is coming up. That's also good. Again, we don't want it too high, but rising oil, we're keeping these guys working. We're keeping the oil industry healthy in the United States right now. So those two things, they can both be a catalyst to the economy for the rest of the year and possibly for a number of years to come. The dollar's still way below where it was years ago. Cheerio then. So we know in retrospect they decided to leave, and given the timing that it took to work its way through the market, maybe it deserves at least a 30-second spot, right? We'll talk about Brexit. And I think one of the complications of Brexit is the timeline. When they voted to leave, we found out that they have to start the process, and it'll take at least 2 years. Well, now the discussion is it'll probably take more like 6 years. And there's also discussion that they'll never leave anyway, that they'll simply negotiate a better position within the European Union. So the only thing that I'll tell you is that although Brexit has left the markets temporarily as far as that 1,000-point shot that we got to the downside, it is not behind us. We will continue to have to follow the headlines and the ebb and flow of who will be hurt and who are the winners and losers as we understand what Brexit is. But I do want to read this headline. It was published in The Economist on July 2nd, and it kind of speaks to the gravity of the situation over there. It is now a week since voters narrowly opted for Brexit, and the country has seldom looked so wildly off the trails. The Prime Minister had handed in his notice. The leader of the opposition is struggling to survive a coup. The pound hit a 31-year low against the dollar, and banks lost a third of their value. It's time to snap out of the daze. The country needs a new leader, a coherent approach to negotiating with the EU, and a fair settlement with those nations within its own union that voted to remain. It's going to be a mess. For now, the market doesn't seem to care, but it will be another point of uncertainty as we continue to make our way through the year. So, where are we going? If Inc. magazine knows anything about it, they say we're going to be laughing all the way through the next year. The corporations are going to infuse a lot of laughter into their corporate cultures and into their advertising so that it will make us feel a lot better. So I thought I'd, lighten up the mood. We talked about a lot of heavy stuff. So let's take a look at some of these advertisements and see if we can figure out what they're actually for. So we got a pair of fish sandals there. Any idea what that's an advertisement for? Not even a guess, huh? Antifungal cream. How about the magician? I guess it's a so-called magician. Glass cleaner. And I guess you would call that a dancing cat. Kitty litter, somebody got it, kitty litter. And my very favorite, cow on a trampoline. Cheese. Milkshake. Ah, woohoo! There is a point here. And, when you're an economist or you're an analyst, you're head of one of these big firms, and you got all these experts, and they're going to tell us about the future. We all have the same picture. We all have the same data. They all have the same numbers. They've got everything to look at. And yet the guess, I guess you can call it a guess, or the assumptions of what it means can be as different as anything. And if I gave you all time, we've got 200 people here in this room, I bet for each of those we could have gotten at least 100 different guesses. So let's go to the experts and tell us about what all this is going to mean to us. Mike Norman, who is a currency trader and an economist, says that uptick in government spending, which will be multi-year, included with a better jobs and economy, will lead to many years of a much better stock market. And I like his quote. It says, life is full of risk, but being in stocks when everyone is bearish is not. Well, Stan Druckenmiller would disagree highly. Stan's a portfolio manager. He's been around for a long time. He manages a hedge fund. And for 30 years, his fund has not lost money. Stan spoke at the Soane's conference in May this year, and he was very clear. Sell stocks, buy gold. Well, we looked at the returns. Stocks are making money, but gold has been making a lot more, right? So far, he's right. He says, simply put, this is the biggest and longest dovish deviation from historical norms that I've seen in my career. Remember that chart that I showed you of interest rates, where they historically have been and where they are now? And well, to paraphrase that second paragraph, he goes on to say that by the Federal Reserve meddling in the markets, they have allowed the politicians to put off necessary reform. And he says we're going to pay for it someday. What about GDP? We talked about what it's comprised of. Where are we going now? Well, for most places around the world, it's estimated that the second half of 2016, unfortunately, will probably be a little worse than the first half of 2016. Yet they tell us by 2017, things will start to get marginally better. Well, again, with all these estimates, I just want to bring you back to January again when we were together the last time. We were talking about a recession just 6 months ago, and they're telling us in 2017 everything will be well. So again, forecasts are just that. We need to continue to pay attention to all of the data that we know before we assess any longer-term assumptions. The economist at BNP Paribas says the Fed's got it all wrong, that they're paying attention to completely the wrong thing. And I guess we could all kind of say, I don't know what they're paying attention to because it doesn't seem to be working. But his assessment is, I'm going to bring you back to, again, something that I showed you earlier tonight. He says it's businesses. They will cause a recession. The Fed is paying attention to interest rates and jobs and consumption, but it's businesses, because when they get afraid and they think there's a slowdown coming, they're going to cut spending, they're going to cut people, they're going to cut jobs. That's how you get a recession. He said the Fed's paying attention to the wrong things. Remember that business spending piece of GDP that we looked at? Business spending going the wrong way this year? Maybe it's something we need to make sure that we're paying attention to. Well, Christine Lagarde, who's the managing director of the IMF, an extremely powerful person, says that with the U.S. economy growing at 2% and unemployment under 5%, the U.S. economy will be just fine. And that although we have a lot of headwinds in front of us, we've got income disparity, we've got one of the highest poverty levels that we've seen in history, that we've got the labor participation numbers going down, that the U.S. economy can move past that and things will be okay here in the United States. Well, we got to talk about the Fed again, right? This chart, and without belaboring more charts for you this evening, I think it's necessary to just talk about how much the Fed has become a moving target. This shows you a progression of time from January of 2016 out till February of 2017. And it's an indication of the probability that interest rates are going to go up, that the Fed is going to start raising rates. And the first chart, the first bar in each section, July 16th, is the probability that rates were going up prior to that May jobs report that we got. The lower one, the purple one, is the probability after we got the May jobs report. So it went down. Now progressively it continues as time goes out that rates will go up. And then the next one, which goes down further, is post the FOMC numbers, which are just a couple of weeks after that jobs number. So that line keeps moving, it keeps declining and moving out further. But now we got the June jobs report, and it was great. What's that going to look like in a month? It is absolutely a moving target. Everything in this country is based on interest rates. And when you have it moving around so much, it makes it very difficult for decision makers. This title here, I could have used in every meeting that we've had for the past 4 years. US bonds are risky. Because every time that rates decline, we're sure we've hit the bottom, which means that rates are going to go up, and that's going to hurt the bond market. We've talked about the massive move of money that's going to come out of bonds and into stocks, and yet money just continues to flow into the bond market today. We do have a new variable in the bond market that does present new dangers. Almost 25% of the government debt that trades around the world carries a negative interest rate. I can't tell you what that means. I don't understand what the unwinding of that will mean. But I can tell you this, it's hurting savers a lot. The lower rates go, the more that people will have to save of their own capital in order to be able to retire someday. The more they need to save, the less they have that they have available to spend. And that goes back into that GDP chart that I showed you. We are 2/3 of GDP. And if we're forced to save more, we're going to have less to spend. Slower for longer. However, even though we say the bonds are dangerous, the US Treasury debt market is one of the few places left in the world with a reasonable interest rate. You can see the difference here. At least the US offers something. You go to the Swiss, their interest rates are negative. The demand around the world for US paper is nothing short of spectacular. And there's a lot of big money out there betting that US 10-year Treasury rates will be sub 1% before this is all over with. That has significant implications to everything. And I'll tell you, I do believe that one of the reasons that the stock market is rallying today is because of this. Where will investors put money? And not just US investors, where will investors around the world put their money? You can't earn money on bonds, it will flow somewhere. And it's a really interesting time in our economy that I feel that there's an unusual situation where you can actually have declining interest rates and a rising stock market. They typically don't go together. Declining rates is usually an indication of a pending recession, that investors are afraid, and it typically means that the stock market's going to go down. Rates are not declining because people are afraid of a recession. Rates are declining because people have to find a place around the world to put their money. It also means that there's a new demand for gold. If you're a central banker, are you going to give your money to Germany so that they can give you back less in 10 years? I don't think so. Gold becomes a store of value. Maybe it is not the indication of fear that it has traditionally been. It's now another type of currency. So the moves in the markets today may tell us something different. And I'm not going to tell you that this time is different. I'm going to tell you that some of the signals that we're seeing in the market are not traditionally how we would read them, given some of these things that we know are happening right now. The emerging markets may be a source of opportunity. And again, it's typically an area of higher risk. But I want to read one line in here. This Mark Mobius, and he's been an international fund manager for years. And I think this statement in here is just so telling, and again, our job is to look for opportunity for you, right? Emerging market countries account for nearly 3/4 of the world's land mass and 4/5 of the world's population. If you don't think there's some opportunity out there, we definitely don't want to close our eyes to what's going on there. You don't have to go and buy emerging market stocks. Just buy some of the greatest corporations in the United States that are doing business all over the world, and you get participation in some of these markets that may offer a lot more growth in the future. So, with all these sources of uncertainty, is it any surprise that the financial markets are the only market where when things go on sale, all of the customers run out of the store? With all of the things that we've talked about, it is an unsettling time to be in these markets. We have a huge advantage in the way we manage money for you. We have the ability to be in stocks or bonds, and don't forget cash. It is a wonderful alternative when you feel uncertain about which direction things are going to go. It's estimated that the right wealth management plan can actually add as much as 3% to net portfolio return. And remarkably, half of that simply comes from keeping clients focused on the long-term perspective and maintaining a disciplined investment plan. That's what our job is. As we move into the back half of 2016, we are very confident, and we're having a great year. We are very confident that way we are positioned, that we're well positioned for what we see coming. Unfortunately, I think the second half is going to be as interesting as the first half, if that's a good word to use. I tell myself that when I get up in the morning, it's going to be another interesting day at the office. So we're well positioned. We're going to continue to make changes as we see fit, as usual. And know that every day we're going to be working to find the best opportunities for your money around the world. So I'm going to share a video with you. And this is in dedication in honor of the Olympic athletes that will be performing this summer in Rio.
When troubles come and my heart burdened be, then I am still and wait here in the silence until you come and sit a while with me. You raise me up so I can stand on mountains. You raise me up to walk on stormy seas. I am strong when I am on your shoulders. You raise me up to more than I can be. me up to more than I can be.
Well, that's the first time I watched it without crying, by the way. I want to thank you all so much for being here tonight. I want to thank you for your dedication, your loyalty, your friendship. It means so much to us. We hope you enjoyed the evening. As Stephanie had mentioned, we do have a small parting gift for you tonight. And get home safe. Thank you very much, and have a wonderful night.